Welcome, everyone. Thank you for taking time today to participate in our webinar. I'm Paul Largo, President and Founder of Freedom Capital Management. Today, we would like to talk with you about a few important topics. We would like to provide you with an update on the markets and recent economic trends. We would also touch on recent portfolio activity in our discretionary investment advisory accounts. We thought it would be helpful to take you inside our research process and in addition, provide you with our outlook for the balance of 2016. And since many clients are concerned about retirement planning, we will discuss some of the financial planning challenges ahead. In particular, the quest for income and reasonable risk-adjusted returns. Another topic for discussion surrounds client communication and correspondence from our broker-dealer Royal Alliance regarding ownership changes and the advisory disclosure documents. And lastly, we would like to make sure you're aware of some of the exciting upcoming client communication and events exclusively for Freedom Capital Management clients, friends, and family. Markets declined rapidly in January and February of 2016 in the face of a global slowdown, oil price declines, and the potential for rising interest rates. Unlike the market sell-off in the fourth quarter of 2015, the first quarter of 2016 market sell-off was accompanied by a fair amount of economic weakness. First quarter 2016 GDP, or Gross Domestic Product, was expected to be at 2.6% annual growth, but was later revised to as low as 0.5%. Company earnings continued to decline for the fourth quarter in a row. We have been in an earnings recession. The markets were able to make it back to even on the year by the end of April, but really without any major positive economic data to support those prices. Instead, it seemed to be on the hope that the Fed, or the Federal Reserve, would not raise interest rates. But is that really a good thing? Here you can see a chart of the price action in the S&P over the past 12 months. The green line at the top of the chart clearly shows where the S&P has tired in the past and provided limited additional upside potential. This upper range seems to be between 2050 and 2150 on the S&P. The red line at the bottom of the chart illustrates the price levels the S&P has declined to during extreme selling and increased market risks. This lower end of the range seems to be between 1800 and 1900. As the perceptions improve, the market heads to the top of the range, and when the market mood sours, it heads to the bottom of the range. This has been developing for many months, and eventually a breakout will likely occur. If the global economy improves enough, we may eventually break above the upper end of the range in a convincing manner and start a new bull market. If the things continue to slow and the mood sours enough, the break below the range could occur and officially bring about the long-awaited bear market declines of more than 20%. Such a decline would officially mark the end of the bull market, which started in 2009. In addition, it could point to the fact that this bear market could have actually begun in May of 2014 and end at some point in 2016. As mentioned earlier, what's concerning about the recent rally from the middle of February of 2016 to late April is that it was not supported by stronger economic data. In fact, economic data weakened while stock prices increased. As you can see from the chart above, the collective earnings from S&P companies have been declining. Even the U.S. gross domestic product growth has declined steadily over the past 4 quarters. Without companies growing revenues and earnings, it's hard to justify higher stock prices. Regarding some of our recent portfolio activity, as markets were declining in the first quarter, several of our research indicators were flashing cautionary signs. As positions broke down, we sold the positions and raised cash levels. Generally speaking, we increased cash and bond holdings and decreased our allocation to stocks in many accounts. Hedged and inverse exchange-traded fund positions were added for the first time in many years. These are positions which can help portfolios hold their value in declining markets, but likely work against them in rising markets. We also reviewed annuity allocations and moved to more balanced portfolios. As the markets recovered from mid-February until the end of April, our cautious stance restricted our ability to substantially participate. However, should markets decline again, our more balanced and defensive mix should help reduce account declines. Even stocks like Apple and Goodyear Tire were partially sold to raise cash. Wells Fargo was sold as well. We combine both technical and fundamental research in our process. The technical research helps tell us if the stock price of a company is doing well. The fundamental research helps tell us if the company itself is performing well in absolute terms. For example, are their sales and earnings improving? Are they the best in the industry relative to their peers? Believe it or not, the fundamentals and the technicals do not always match up. We try to find companies that match with both solid fundamentals and technicals. Specifically, we look for companies that have a buy or strong buy rating by S&P and our other analysts and have a strong technical chart pattern in a long-term uptrend. Since 1987, Dorsey, Wright & Associates has provided independent research and provides a good perspective on risk management. I have personally worked with their research since I started in the business in 1997. A closer look at an example would be Medtronic. Medtronic was recently bought in our WMP accounts. It holds a strong buy from S&P and a technical score of 5 from Dorsey. A good combination which we feel has a high probability of investment success. The red dotted line is the long-term uptrend. Over the years, you can see a steady climb of higher stock prices and higher stock price lows. In addition, their pipeline of medical device products is very strong, and revenues and earnings are projected to grow at a steady pace in the years ahead. The green circle on the chart highlights what is considered a buy signal. We recently sold Wells Fargo. Although Wells Fargo is an excellent company, it recently faced a number of fundamental downgrades, and its chart price declined enough to see its score reduced and its uptrend line violated on a short-term basis. The score gives us a sense as to the technical strength. A score of 0 is weak and 5 is strong. Wells Fargo's technical score declined recently along with the fundamental downgrades. While it is still in its uptrend, the next level of support is all the way down at $34 to $36 a share, more than 20% below its current price. As a result, it was sold. The red circle on the chart highlights the sell signal. For the remainder of 2016, we are looking for either the data to support the current market prices, which means it would have to improve significantly, or for the markets to decline, potentially 10 to 20%, to more closely match the reality that the U.S. economic growth has been slowing. In addition, the Federal Reserve really can't control markets over the long term. They can only influence short-term actions. On top of that, Global central banks are trying anything and everything, even negative interest rates, to stimulate growth. But countries are not addressing structural reforms that are so desperately needed to achieve long-term growth. Once the markets begin to trade with the fundamental understanding of the above points, investing will make more sense. So our 2016 game plan, based on today's data, which of course is subject to change as we are in a dynamic world, suggests that we expect markets will trade in a wide range. When economic and central bank comments and actions are positive, it will be at the high end of the range. Those levels, we look to have raise cash and trim profits. We think 2050 and 2150 on the S&P is more than likely the upper end of the range where downside risks outweigh upside potential rewards. As the markets trade lower to the lower end of the range, typically on recession fears or realities, or simply continued signs of a global slowdown, we will reduce our cash, remove our defensive positions in inverse exchange-traded fund positions, and use that money to allocate more assertively as the markets trade in ranges where valuations are more sensible, somewhere between 1750 and 1850 is a more optimal level on the S&P to be more assertive with those investments. Everyone is seeking fair risk-adjusted rates of return, but when you look around, look what things are paying today. You can loan the U.S. government money for 10 years with an average annual return of 1.79%. You can buy a 1-year CD at 0.75. You could buy a 5-year AAA rated corporate bond at 1.45%, or you could invest in the S&P with a dividend rate of 2.40%. Investments we like would be blue chip dividend stocks with dividend yields over 2.5% and growing. We also like alternative investments, such as real estate investment trusts and business development companies. And of course, companies with strong revenue and earnings growth potential regardless of global GDP levels. The S&P has not made a new high in over 20 months. In fact, not including dividends, the S&P and Dow posted negative investment returns in 2015. Many bond indexes were negative in 2015 as well. The average annual return on the S&P over the past 20 months is just 0.3%. Stocks like Disney, Apple, Google have all posted negative returns over the past 12 months. Disney is down 15% from its high or more from August of 2015. Apple is down well over 30% from its high in April of 2015. And Google is down more than 12% from its high in February of 2016. Even after the recent oil rally, Chevron, while up in 2016 over 10%, is still down more than 20% from its high in July of 2014. The 5-year period from 2014 to 2018, in our opinion, will likely show the end of the bull market from 2009. The average annual returns will be between 3 and 5% on stocks, as the many months of flat markets coupled with multiple 10% or more downside moves and eventual recoveries will bring average annual returns lower until the new long-term bull market can start again. These are good reasons to hold a diversified portfolio of investments as well as stocks. The use of cash on a tactical basis could prove very helpful. The incorporation of insurance products and private investments with the potential for steady monthly income can potentially reduce overall portfolio volatility. With below average returns, we may also see above average volatility as investors contend with global central bank actions, poor policies, and lack of structural reforms, along with geopolitical shocks such as ISIS, OPEC, and North Korea. Retirement planning. Many of you have worked with us on retirement planning, and one of the biggest things we talk about is to know your expenses. Clients tend to underestimate their monthly living expenses, and it can lead to inaccurate probabilities of success for sustained income in retirement. Plan for the worst. We would rather clients increase projected expenses in retirement, just as we would reduce potential rates of return on portfolios in the future. Work with us and our software program, Money Guide Pro, to project potential retirement outcomes. This software program is free for all clients. Our certified financial planner, Dave Teeter, helps to run the projections using the plan. Oftentimes, we guide clients through the process of selecting Social Security and pension benefits and try to keep annual withdrawal rates below 4%. Studies suggest that taking less than 4% of your retirement assets each year can be extremely helpful in the longevity of your assets throughout retirement. News from Royal Alliance. Our current broker-dealer affiliation is with Royal Alliance. Recently, you received a notice about a new owner, Lightyear Capital. At present, this does not affect us or your accounts in a significant manner. We will closely monitor this change for any potential negative effects on our ability to service our clients. In addition, a notice was sent regarding fines levied on Royal Alliance from the SEC and credits to customer accounts regarding mutual fund share classes. This notice was sent to all clients of Royal Alliance advisory accounts. It does not mean it affected you. In fact, we use a large variety of individual stocks and low-cost exchange-traded funds in most of our advisory accounts in an effort to keep costs low for our clients. Lastly, we wanted to talk to you a little about future client communications. We have a variety of client appreciation and dinner events. Many of our clients have commented on the past events and expressed interest that we continue with new programs to engage on various levels. Below are some of the events we are planning for the balance of 2016. On June 7th, we are holding a client appreciation dinner and education event at the Salt Creek Grill in Rumson, New Jersey. We will also launch FCM University, a series of brief but powerful educational webinars on a variety of topics. Some might include Estate Planning 101, or naming your beneficiaries, or the basics of investing. We will also have our second annual Client Privacy and Shred event. Last year's was a huge success. And new for 2016, we'd like to add a series of events to help keep clients active and educate them on healthy living ideas. Events like client group yoga, walks, healthy cooking classes, skincare, and even a wine tasting event, because I think we all know a glass of red wine has long-term potential benefits for some of you. I'd like to thank you very much for your participation today, listening to our presentation, and I encourage you to reach out to us with questions, concerns, or to schedule a meeting to review your investments in the near future. We appreciate the trust that you have placed in us and do not take our responsibility lightly. Thank you for your time, and I hope to see you at our next event.